William Balsamo from Western Michigan University. The most important lesson I think myself and the rest of my teammates learned was time dedication and how to properly apply not just things that we learned from classroom experiences, but how to take them and apply them in a real world setting, such as the CFA Challenge. Teaching ourselves. I think you can only learn so much from a classroom, and really getting a good feel for things that go into company valuation and all the things that the CFA Research Challenge, the obstacles it provides, allows for a lot of self-teaching and peer education. I hope to go into private equity, and I think that company valuation along with the public accounting field will definitely go hand in hand and be able to benefit one after another. And I would highly recommend the CFA Challenge to anyone pursuing a finance, accounting, any kind of business degree, because it can be multi-beneficial.
Hello, my name is Jacob Adams, and representing Western Michigan University with me today is Eric Reynolds, Richard Elias, and William Balsamo. We composed an equity analysis on Neogen Corporation, which is the topic of our presentation today. I'll quickly go over the company profile and recommendation. Eric will begin to support that recommendation with an industry overview. Richard will go over the financial analysis and valuation sections, and William will close with the risk analysis and summary of our presentation. On the left, you can see some basic metrics. They closed 2014 at the top of their 52-week price range, and they have a PE of 65, which we believe will begin to decrease as value increases, which is something we'll get into on the next slide. They had a very balanced revenue structure, with 50% of the revenue coming from their food safety segment and 50% of the revenue coming from their animal safety segment. They draw 60% of the revenue from the United States and 40% of the revenue from a diverse group of over 100 countries that include the likes of South America, Europe, and China. We recommend a buy with a 26% upside based on the discounted free cash flow to the firm method, using a perpetuity growth rate of 4%. We believe key value drivers will be continued synergistic acquisitions, which increase market share, heavy regulation and increasing heavy regulation, which increases demand, and a comprehensive product line and growing product line, which allows them to capitalize on that growing demand.
All right, and taking a look at the industry, they are in an industry that is impacted by government regulation for food and animal producers. Obviously, as an increased demand for regulation increases, demand for their products should increase as well. And conversely, if there was any kind of tightening or loosening of government regulation of their industries, you may see a decrease in demand. However, that situation is not likely to be seen here going forward. Looking at the domestic market, we have a well-regulated market with a number of consumer advocacy groups that should continue to keep heavy restrictions on food and animal producers. As well, that coupled with strong U.S. growth, we believe makes our market very strong going forward. And looking internationally, we believe there are great opportunities internationally, specifically in emerging markets. As their middle class rises, we believe there should be seeing a greater emphasis on food safety and regulations of the food and animal safety industries, specifically with care and vaccines and feed for animals that are bred for human consumption. The food safety industry, with food safety testing diagnostics, are both the food and beverage industries. And of course, as goes back to the domestic and international regulation changes or standards I had mentioned previously. Animal safety for both production and companion animals. Again, the biggest thing we see is the growth in emerging markets and the care for animals that are bred for human consumption. And taking a look at their competitive positioning, they do face a number of competitors. They don't have necessarily a one-to-one company that competes with them. They have many different companies that compete with different products that they offer, and they range from anywhere from small startups to large multinational corporations like the Elanco, Zoetis, Quiagen, which those larger companies do have more revenues and more resources at their disposal. However, we believe not only does their space in this market show that there is a strong demand for these products going forward, We believe Neogen has positioned themselves well as being a one-stop shop as they have a strategy of serving the entire logistical supply chain for food and animal producers. And we believe that gives them a good advantage as when companies do have an emergency or have a problem arises, they can count on Neogen as having the products and services that they need at that time.
Taking a look at the financial data of Neogen, we find that international sales growth has been stagnant with a stable percentage of total revenues between 39 and 41% since 2008. We do anticipate that this level of growth will increase due to the recent acquisition of Anapure back in December. Neogen does not have any interest-bearing debt at this time, yet they have a revolving line of credit of $12 million extending to September of 2017. Because they have no debt, they have the advantage of holding on to a larger sum of cash that could be returned to shareholders, or it could be used for business operations such as synergistic acquisitions. We find that profitability ratios have healthy levels of growth and are consistent with historical averages. Although Neogen does not currently pay a dividend, we anticipate that earnings per share will grow to 94 cents per share and $1.14 per share for forward years 15 and 16 respectively. This is a conservative estimate, as this level of growth year over year is below the 5-year average of 23.5% as of November 31st. This brings us to the value we place on Neogen. We utilized the discounted free cash flow to firm method, which yielded a value per common share of $62 based on a weighted average cost of capital of 6.74% and a perpetuity growth rate of 4%. We project a forward PE of 65.2 times for forward years 15, and then a declining PE to 49.6 times for forward year 19. We anticipate that earnings per share will grow over 100% over the next 5 years, and we estimate that these valuations are in line with historical averages. Now, Bill will talk about the potential risks.
After conducting our research of Neogen, we identified several risks that the company currently faces and could potentially face in the future. A mix between market risks, operational risks, strategic risks, regulatory risks, and legal risks, 2 of which stood out. The first being the strategic risk of being in highly competitive markets, and the second being the legal risk of maintaining intellectual property and other intangible assets. And to pan off that, an ever-growing company, the way that Neogen operates, is going to develop significant intangible assets, through organic growth and through the synergistic acquisitions the company has made, which is ever going to increase the need to protect those assets. And one way the company itself reduces the risk is first through 61% of the revenue we've already discussed is done in the United States. And of the 39% done in foreign countries, they're done in countries such as the UK, Germany, France, and the Netherlands, and all of which maintain high levels of protection for intellectual property itself. And also, Neogen uses trade secrets versus just the standard patents. And the reason is to protect the proprietary nature of a majority of their products. For example, how they develop significant microorganisms that they use in their products. They actually store those at separate locations just to, again, alleviate this risk. The next one being just the general strategic risk of entering into highly competitive markets. And the reason this risk is so significant is because they're not just apples-to-apples competitors with other companies. It's against small companies that have niche markets and large companies that have more significant financial resources. And the way that the company really mitigates this risk is through their wide array of products they offer and through the ease of use, the speed, and the accuracy of Neogen's products. And management currently knows of no other company that has the same fundamental aspects of Neogen. And what I mean when I say that is offering products all the way from animal testing kits to veterinary pharmaceuticals. And with that said, we again highly recommend Neogen as a strong buy with a conservative 26% upside. And the reason that we describe it as a conservative number is because using a 4% perpetuity growth rate compared to a 5% organic growth rate over the past several years and looking forward makes it a conservative growth, not even taking into effect how the company is going to grow through further acquisitions, which management has already stated is going to be a fundamental foundation of them moving forward. And looking at the synergistic acquisitions in the past and forward, the heavy regulation that's going to push demand and the comprehensive product line that's going to capitalize on that growing demand is going to make Neogen and the stock price exactly where we put it. And after the key risk mitigation and the profitability over the past 84 quarters, it's going to continue to be a profitable company from now into the future, and that's why we highly recommend it for any stock portfolio you may have. Thank you.
What is the company's cash flow from operations on an annual basis, roughly, or?
Cash flow from operations is about, I think it's about $85 million or so in that area.
And they're using their cash just to buy these companies, because they've made, what, 27 acquisitions since 2000?
Correct.
Now, what percentage of those acquisitions have been international versus domestic?
They are starting to really work on international acquisitions. Again, they just bought Anapure, which is in China. I'm not exactly sure on the exact percentage of domestic versus international. We just know that going forward, international acquisitions are a key target for Neogen.
You had mentioned here in the United States that regulation is actually a positive, which is kind of strange because normally when the government's involved, it's not a positive. But have there been any changes in pricing because of that, or is it just more of a volume type benefit to their sales?
I should believe that it's more of a volume, because it is a competitive market, so there is some kind of restriction as far as how they can price it, but more as far as demand, volume demand.
Okay, and if you look at their margins on the animal side versus the food side, the animal side is quite a bit less. So going forward, would you expect management to have more M&A on the food side of the business or on the animal side?
I think that has to do with demand. I think that they're going to want to, because like right now they have, like we said, a balanced. They get 50%, roughly 50% of the revenue from the animal safety side, and 50% from the food safety side. I don't think that they're going to concentrate on the one with the larger margin. I think that they're focused on being a one-stop shop and having that niche of being a one-stop shop, and that's where they're going to derive most of their value. So yeah, I think that it's not going to be a particular focus on investing more in the higher margin industry than it is a focus on capitalizing on the demand that they see that's increasing, which is a demand for a one-stop shop.
Growing faster than animal or food?
I believe that it changes year to year, I do believe, and it's based on the needs of the market. I know that this past year they had more revenue come from the animal or the food safety side, the higher margin safety side because of the higher margin side because of the horse meat scandal. And I know that I read an article last night. They said that there may be another scandal here coming right around the corner with increases in peanuts in foods that it shouldn't be. And it came out last night, but I don't.
From a management side, their fearless leader is 75, and you guys had the opportunity to go visit with investor relations and then I think a member of management. Were there any outcomes from that as far as how they go forward?
Well, initially during the investor presentation, my take on that was they're moving forward with these acquisitions. That's what they're trying to do. They're buying up small companies, medium-sized companies, and working in that aspect. Again, they're growing internationally at greater levels than they are domestically, and that seems to be a continued focus for them.
Following up on John's question about regulation, do their products go through like an FDA approval process or what?
I know that the process is less large than the human pharmaceutical market, which is another huge reason that the industry that they're going into is awesome in my opinion, as opposed to, say, the competitors we highlighted being Elanco and Kaigen, where they do focus a little bit more on some pharmaceuticals. So yes, they do have to go through a bit of a process, but it's much smaller than the human pharmaceuticals market would, which again, what we believe increases value relative to those pharmaceutical firms.
And then to kind of add on to that, obviously with the FDA, it's really just like their veterinary pharmaceuticals, other than opposed to like their testing kits and things like that, kind of being separated as opposed to an FDA regulated part of their business. So not everything that Neogen produces has to go through government regulation.
Do they do all their R&D in-house, manufacturing in-house, or do they contract that out?
They do a little bit of both. I know they do a lot of contracting outside. They work with, again, other firms for some of their products. They have recently, I believe, cut back a little bit on the R&D, but that is something that they will continue to sustain increasing wise going forward from here, as that's definitely needed in this industry.
From a valuation standpoint, their competitors that are public companies are very thin. So you have a slide here that kind of goes into Qui-Gen and Elanco as far as a division of Eli Lilly. Was that a hindrance to trying to value the company?
Just their existence.
Yeah, how to value them versus a competitor in terms of the valuation and then the PE that you assigned and then the forward growth rates was.
That wasn't so much something we really took into account. We did look into that a little bit, but because Neogen just has a completely different business model than any of these other companies, it was quite difficult to value with exact numbers in what you're looking for.
You had mentioned, or in that one chart, about the three big competitors. Where's IDEX fit into the competitive dynamics? I know there's not a lot of apples to apples comparisons in this field, but did you look at IDEX at all?
We looked at it a little bit, but we thought these three companies that we presented to you were a closer representation of what Neogen does. Again, they have a very different type of business model, and so it's difficult to compare specifically, but we just thought those three companies were a better representation of competitors.
You had mentioned in your DCF analysis, I think you were going to use a 4% organic growth rate versus what, 5% historical?
We used a 4% perpetuity growth rate for our discounted free cash flow of the firm.
How many years?
2020, I believe.
With a significant percentage of their sales being international, did you consider the impact of the strong U.S. dollar on their sales?
Yeah, yes, we did. Currently, the U.S. dollar is affecting their international sales negatively. However, domestic sales are increasing to the same degree. Dollar indexes obviously take a role in any firm that works internationally, but as currencies come back and up and down, it stabilizes. That I don't see it as too big of an issue for them at this time.
Have you been able to quantify that at all when you sat down with them, or?
We did not specifically ask them that question.
Do you know how much management owns of the stock?
I do believe there's 4.5% of total stocks outstanding owned by insider shares. Yeah.
And are they big on options and things like that?
They do have stock options for employees, just like a lot of companies do. I don't see them as a company that portrays their stock options as a large part of operations, but that definitely is an element to it.
Do they buy back shares to offset the share dilution?
They do. We have not found anything that indicates that they are going through a large buyback program right now. However, they've shown at times to buy back shares. Again, they don't use debt, so they have to keep raising capital somehow through free cash flow. But if they were to issue shares, that would be another source of income or source of equity.
Have a lot of the acquisitions been done with shares or cash?
I'm sorry.
Have the acquisitions that companies they've acquired, do they purchase them with shares issued, or?
That information is actually quite difficult to find. They don't specifically say if it's through cash or stocks. Going through their financials, we found that most of it is through cash acquisition.
Thank you.
Thank you. Thank you.
Thank you.
Thank you.